Us. Joining us also is Rajesh Palvia, who's technical analyst at Axis Securities, joining us this afternoon. Rajesh, talk to us about how you're viewing markets. It's another day of trade where we've given up pretty much all the gains. The resistance is sharp. I'm trying to get a sense on how you're viewing it and when does the tide turn?
So good afternoon, Harsh. So it's a choppy market. Looking at the Nifty behavior, 25,900 is acting as a major supply zone for the Nifty. And again, in today's pullback action, also Nifty, witness a supply from those level. Call writers are confident around 25,900, 26,000 level. There is no as such unwinding has been witnessed despite we have seen pullback in first half of the trade. So the major supply zone 25,900 until the Nifty not crosses these level, we may see a range bound activity in range of like 25,700 is the immediate support area for the Nifty, and on the higher side 25,900. I think we could see the trading in this range only for Nifty. But Bank Nifty is showing sign of strength, and here one can see more traction on the buying side as Bank Nifty manages to cross major call concentration area of 60,000 and sustaining above those level. So I think if it continues to trade above 60,000 mark, I think we could see another 300, 400 point up move in Bank Nifty. Here we could see more, opportunity on the long side of trade. So those who wants to play on index, they can play in Bank Nifty with stop loss of 59,800, upside target 60,200 to 60,400. We could see next 1 or 2 trading session.
Let's switch focus. Largest private sector lender, HDFC Bank, also the largest constituent on the Nifty 50 index, all set to announce its third quarter numbers. Street expects another steady performance with improved margins. My colleague Mithali joins us with what we can expect from an HDFC Bank.
For HDFC Bank, the street is estimating a steady performance for Q3 FY26 with 3% quarter-on-quarter growth seen in advances and deposits, and also the loan momentum similar as of Q2. Margins are likely to improve sequentially with NIMs seen at around 3.39%, supported by better deposit repricing. If you talk about their cost ratios, they're expected to remain stable with OPEX growth in low single digits. Asset quality is seen stable, though some seasonal stress due to the KCC and agri loans may emerge. Credit costs are also expected to remain constrained. Profit is projected to grow in low double digits year-on-year basis, despite being largely flat on a quarterly basis. Key monitorables for the company's results include management commentary on the margin trajectory and also the exit NIMs, loan versus deposit growth balance, outlook on the retail and unsecured lending, mortgage growth strategy, and also signals on the capital usage and FY27 growth.
Right. And Mithali, what's the expectation from ICICI Bank?
So we have ICICI Banks declaring their results tomorrow, and the street is estimating a steady performance for Q3 FY26 on the back of stable margins, controlled costs, and healthy asset quality. The net interest income, it is expected to grow on the back of consistent loan expansion and stable yields. While if you talk about their margins, they're expected to be in the range bound 4 to 4.5%, broadly flat on a sequential basis as lower funding costs offset the pressure on the asset yields. On the bottom line, the profit after tax, it is projected largely flat sequentially, but you might see an increase on an yearly basis, an increase of around 4.7%, reflecting stable core earnings and also benign credit costs. Also, the asset quality trends, they remain encouraging. Looking ahead, the loan and deposits growth, it is expected to be around 3.5% and 3.8% respectively, with digital platforms gaining traction. Additionally, the credit costs, they are expected to stay under control, while the implementation of the expected credit loss norms, it is actually going to have a positive large impact on the company's earnings visibility and also the strengthening balance sheet. So overall, ICICI Bank's Q3 performance is expected to reflect stability, resilience, and also disciplined execution.
Okay, thank you so much for that, Mithali. Rajat Sharma, founder and CEO at Sana Securities, joining us this afternoon as well. Rajat, we've seen a decent pullback when it comes to an HDFC Bank. We've also seen some bit of an underperformance when it comes to ICICI Bank. Good time to nibble on just prior to the numbers. Is that something, or is that a segment of BFSI which you're looking at actively, and you think that there's value there?
Yes, no, just before the numbers would actually be a good time to buy into this. Now, based on the kind of numbers we've seen from financial services in general and banking stocks in particular, yesterday IOB reported very good numbers, Union Bank reported pretty much subdued numbers. HDB Financial reported very, very good numbers. So it's been a very, stock specific good or bad numbers, if you may. But I think HDFC Bank in particular, as it is, if you just forget about the fact that it's due to report numbers, is right now trading at very attractive valuations. It's the largest bank, it's got a great price to book. I mean, if you look at the metrics, it's a bank available at very, very cheap valuations, and one of the best franchise in India to own. And given where it's trading, I would think that if the numbers are anywhat better than subdued, if the way everyone's projecting it to be, then this stock could jump up quite nicely from here. Also, keep in mind that personally, I'm optimistic that in this budget there would be some relief in terms of taxation, whether it's long-term tax, just to attract FIIs back into the country. And HDFC Bank is, the favorite stock for FIIs. Traditionally, if you look at it, that's where they've had the highest allocation. So no matter how you look at it, it's very, very well positioned. Both HDFC Bank and ICICI Financials is a sector where, we're looking to add right now.
Very interesting. Rajat, what about Reliance Industries, though? Looks like a value buy right now, but do you think earnings can actually justify that, if indeed it were a buy at these levels for you?
Yeah, Aisha, I have to give a disclosure. I don't have Reliance Industries. I don't track this stock very closely because, I personally feel this is a stock which will always keep moving in line with the overall markets. Nothing beyond that, nothing under that. They've got so many diversified businesses that I stopped looking at it really.
Okay, Kunal, let me come to you with regard to a technical check with regard to HDFC and ICICI. What's the take there?
Yeah, we've seen a good recovery for HDFC Bank. The stock recovering from those 925 kind of a zone. 960 still remains to be a breakout point for HDFC Bank. Hopefully, post results, if the price action is on the positive side, we might expect that the stock actually shows that kind of a breakout, which has been due and pending for quite some time for HDFC Bank. For Reliance Industries, that breakout point is around the 1490, 1500 zone. This was the previous swing resistance for the stock price on the daily chart. So we need to see these breakouts being taken out for the stocks to come back into a strong recovery phase.
Look at the breakout on Federal Bank though today, 8.5% higher. Rajesh, what's the reading on the charts for either a Federal Bank or any of the PSBs for that matter?
So Federal Bank has managed to give breakout of its previous swing high, and now stock is back to all-time high trajectory. Looking at the today's move, especially very strong volume action, and now stock is showing a sign of strength despite so much of run up in today's session. I think if stocks manages to surpass again 272 level, I think upward trajectory around 285 to 290 we could see in near-term perspective. So buy and accumulate would be the strategy. On the downside, 262 needs to keep as a stop loss for Federal Bank. Again, if I go with the public sector bank, I think Bank of India is showing sign of strength, and the way a stock is moving in series of higher top, higher bottom formation, I think here we could see more traction towards 165, 170 zones. So Bank of India is also looking attractive. On the downside, 154 needs to keep as a stop loss.
Okay. All right. What about Reliance, Rajesh?
So Reliance is now trading around its 100-day moving average. If I go with the put-based concentration, 1450 has attracted a major put writing activity. Looking at the near-term structure, stock is poised for giving some pullback action from the current level, as from the lower level 1450 acted as a good support area in past also. So risk to reward is in favor to play some pullback trade here. So I think one can keep a stop loss towards 1425 if you're buying here in Reliance Industry, or you can play with some call option buying. You can buy around 1450 call option, which is trading at around 34 rupees. Keep your stop loss at around 20 rupees, and we believe that some pullback action can be there in this counter, and possible target towards 65 to 70 we can see for call option.
Interesting. That's where within IT, if at all, are your biases and preferences?
So Aisha, two stocks that we've added. One is, a stock where I had a fairly large holding, which was added before the results, was Infosys, because, as I said, the two platforms with which they're working, Nia and Topaz, I looked at this around 2-3 months back and talked about it. They're going to implement AI use for their customers and clients, particularly in manufacturing and financials at a mass scale. And we've seen this before, whether it was cloud a few years back, then digital, and now implementation of AI. Indian IT always lags behind, the US, where a lot of this high-end developments happen, and Indian IT then implements it at a mass scale. The valuations at which IT sector is trading right now are not cheap compared to the last 10-year averages, but they're in line. The Nifty IT index in all is around 25, and right now it's trading at 26. So it's slightly more, 5-7% more expensive than its average. Be that as it may, that's primarily because the sales, the total revenue has not increased for the last few years. But with the positive guidance that we saw from Infosys, keep in mind, it's not so positive. They've just increased their guidance from 1 to 2% to 3 to 5%. Compare this with 16-17% growth in earnings kind of guidance, which they used to have until a few years back. But the sentiment is changing, and they're really, really undervalued, these stocks. So that's first stock where we've added more. The other one is a mid-cap IT stock, which is Birla Soft, because, they're again at a forefront of implementing artificial intelligence and training the staff of their customers on how to use AI. It's a platform called Skillshare that they have. And as it gets close to the $1 billion mark in revenue, Birla Soft, I think there would be a re-rating on the cards for that. So these are the two IT stocks which we've added. I will also give you a disclosure. IT remains right now my favorite sector because, I believe in value investing, and I believe in holding stocks for multi-year, not like my long term is not 3-4 years, it's 5-7 years. And IT is a core sector. It will eventually bounce back.
Okay. Rajat, also keen to understand your views on defense, because this FII, the FII cap, which will likely be moved upwards from 49% to 74%, does that materially change the way one looks at defense? Because this will mean foreign participation in a far larger fashion in Indian companies, and therefore the Make in India agenda will see a lift, and this at a time when we're very, very close to the budget as well. So all of it, how are you looking at defense, and how does this kind of change the thesis, if at all it does?
No, as I just said, I don't find value in this sector. Most of the stocks you look at are trading at such extreme valuations that, despite the recent correction that we've had, they'd already run up so much in price that I think a lot more correction needs to happen. Yes, the world seems like an unsafe place, and, a lot more money is being pushed into defense companies, particularly in India. But I've really not spotted anything in the listed space where it's the same names, Mazagon, Bharat Electronics, and BHEL, and, Tejas Networks. A lot of these companies are trading at such extreme valuations that, when I look at them, no matter what kind of growth I factor into them for the next few years, yes, if there is an increase in the FII cap, these stocks might just, show a knee-jerk reaction, go up 5-7%, but will eventually cool down and come down to, they have to be at the right price for someone to buy these.
Rajesh, what are you making of the price action on Eternal?
So for this week, it's a choppy week for the Eternal. But if we analyze last 3-4 week price behavior, it's in range itself. Stock not able to surpass its 295 300 supply area, which is very important and critical for the stock. Though looking at the near-term behavior, stock is having good support area at around 280 275 zone, which is very important for this correction. So I think the selling pressure is absorbed around those levels. So I think if it continues to trade about 280-85 mark, I think some buying interest would remain in this counter around these level. Any breakout about 295 can take stock further higher to 310. So I think after a correction now, consolidation is happening in range. And we believe that that stock has potential to give breakout on the higher side. So 295 one needs to watch closely. If breakout happens, then one can add more positions.
Okay, so that's with regard to an Eternal. Kunal, do you have a view with regard to this one?
Yeah, I think over the last 1 week, the stock has seen almost like a 8 to 9% recovery from 274 thereabouts to 295, 300, where the stock tested on Wednesday. And today it's coming back into a kind of a corrective phase. So it's come back to the midpoint of this 25 odd point range for Eternal. 275 still seems to be a strong support over the stock price. However, I think today's volume being on the much higher side as compared to the volumes in the previous days when the stock had done quite okay for itself. So that indicates that this could be maybe a fresh round of selling which could have happened to the stock price. So not initiating a buy, but I think maybe this time around if the stock drifts down to that 274 mark, there could be a second attempt where the stock may try and go into a bounce back mode.
Okay, that's with regard to Eternal. So the IT counters, Rajesh, I'm curious to know, Tech Mahindra in particular, that's one of those IT counters which are absolutely flying in rate, 5% higher. How is this one looking on charts?
Very strong setup for Tech Mahindra, and stock now managed to give breakout of its previous swing high of December also. And looking at the short-term structure, we believe that until stock is trading above 1640, 1650 mark, I think we could see further higher trajectory towards 1730. That's the next target where we are focusing on this counter. So those who are already bought stock at lower level can trail stop loss at 1630 to hold the position for 1720, 1730 kind of target in the continuation of this up move.
Okay, all right. A Wipro on charts, Kunal, very quickly.
See, it looks attractive, and given the fact that the stock has seen almost like a 20% recovery from 220 levels, which was the low for Wipro in the month of September, October, towards the point when the stock had recently moved towards the 270, 275 zone. So this seems to be a very strong recovery which has come back for Wipro. And price-wise also, even on relative strength-wise, it's come back towards the top 3, top 4 performing large-cap IT names. And it's also exceeded the likes of TCS, for example, in that context. So I would believe Wipro could be a decent chart to look out for. The supports for the stock in the near term is still around the 255 mark, which also coincides with the 50-day moving average for Wipro.
In fact, let me take it across to Snehi and understand what the ET Now poll is factoring in for Wipro as well.
Well, yes, some more IT earnings to watch out for from the big names. You have Wipro that's going to be coming out with its numbers, and we're expecting a largely very flat quarter for Wipro this time around. On a consolidated year-on-year basis, revenue is expected to go up by just 3.2% sequentially at 23,428 crores. EBIT is expected to be up about 4% on a sequential basis, but PAT is where we are seeing some pressure on account of the labor cost charges that we've seen. This has impacted other names like TCS and Infosys also. So we'll watch out for what the impact is over here. But yes, we're expecting to see about a 3% downtick on the net profit in a sequential basis. EBITDA margins are expected to remain absolutely flat at 16.7% on a sequential basis. Here are some key expectations then. The residual ramp up of the Phoenix mega deal and the recent deal wins should aid the top line growth for Wipro this time around. IT services EBIT is expected to dip. They expect order intake, especially for large deals, to remain healthy given ongoing aggression in large deals pursuits by Wipro. So this could be another factor that could be important to watch out for. And the residual ramp up of the Phoenix mega deal, like we spoke to you about, is going to be a catalyst one to watch out for.
So when the numbers do come out, watch out for demand trends in affected verticals like retail, energy and manufacturing. And on the flip side, what is the growth in some high growth verticals like BFSI, pricing stress in large contracts and the resulting margin impact, strength of the large deal pipeline and conversion rates, and pace of Gen AI adoption. And of course, the impact that other IT companies have seen on the back of this one-time labor cost charge. So we'll be watching out for what that impact is over there. The constant currency growth, the impact of the H-1B visas, all of that is going to be very key to watch out for. So keep a close eye for Wipro.
Okay, that's about Wipro, and it's really all about IT as we wind down on the week today. Other than that, Rajat, where from within the earnings season this time around are you anticipating any positive surprises, if at all?
Yeah, I'm happy you asked me that, Aisha, because the space that I'm really looking out for is actually a very boring space for most people, consumption, and within consumption, FMCG. Look, the reason is FMCG stocks had been struggling on account of a lot of competition from unregulated players because the GST was implemented a few years back, which was really high. Now with GST down to 5% and almost zero GST on a lot of items, there's a lot of stocks which have fallen in terms of value. Even if you look at the top two stocks of the FMCG index, HUL was reporting a revenue of something like 39,000 crore, the top line around 5 years back. Today, that has jumped up to something like 64,000 crore. Yet, the stock price is 2,300. 5 years back, it's 2,300 today. It's not moved at all. The same time, the valuations for the stock 5 years back it used to trade at 65, 66 kind of trailing price to earning. It's now down to 44. So any improvement in earnings there, any growth in volume in this part should take, the stock price higher, because I don't think it's going to fall any more from here. Purely if you look at the 10, 20, 30-year kind of valuation. Same problem with ITC. Of course, ITC's right now been hit by a major hike in the tobacco taxation. Be that as it may, the other problem which ITC also has is that the revenue from FMCG non-cigarette is not translating into the profit, into net profit. So they get about 25 to 26% from non-cigarette FMCG. So FMCG sector, I'm looking forward to, the earnings, because this is now onwards where you'll see the real impact of, GST cuts being felt. A lot of these unregulated players, which were giving them intense competition, and also online commerce. Now, HUL and some of these bigger companies have got into that space and creating their own digital presence. So this is a space to watch out for. Also, again, because the valuations, more than IT, it's actually the valuations in the FMCG sector, which nobody believes has cooled down. Look at the 10-year multiple and look at the current multiple. You'll see that it's all trading 20 to 25% below. So that's a space where I'm looking out to, watch out for earnings there.
All right. Okay. Rajat, Rajesh, thank you so much. We'll let you go on that note. It's another